Welcome to this special episode of the Advisor Insider Podcast powered by ETF.com. I'm Jeff Benjamin, ETF.com Wealth Management Editor, and we're talking bond math with Alex Morris, the Chief Executive Officer at FM Investments. How you doing, Alex?
I'm good, thanks.
All right. Well, thank you for being here and helping us out, walking us through this. We're gonna kind of hit some high notes and some low notes of what's going on in the fixed income space right now. The Fed cut rates this month for the first time in more than 4 years, and that introduces potential risk and opportunities for financial advisors and fixed income investors, of course. Let's start with the logical assumption that lower interest rates means lower yields on most bonds, therefore making equities the more attractive investment opportunity right now. Am I wrong, Alex?
No, there's a lot of right in what you just said.
Okay.
It probably doesn't play out so simply, right? If it never does, this is
That's
bond
why
math.
this is bond math, right?
Ex-
It's a fun way of learning.
exactly. It's one of those things where we all learn a little bit. Some of us just get stuck in it and love it. But this is what's going to be interesting about the bond math, not just the mathematics that go into how we calculate yield and some of the
Hmm.
other bits of jargon, but how it plays out. Because when we say a bond, that can mean a lot of different things. And when we talk
Hmm.
about rate cuts, we're really talking about this short-term Fed funds rate. This is what the Fed is going to lend money to its member banking institutions to help put money into the economy. And when we look at the yield curve, we look at this boxy rectangular thing, but we forget that although we see in general 10 key benchmark points, they're spaced pretty evenly across the curve. That whole thing represents a 30-year time span. And the
Hmm.
first, two-thirds of that is where nine of those 10 points generally are, right? The 20-year comes and goes from time to time, but so maybe it's 11 points, depending upon when you're looking at it historically. But the thing is, we just because short-term rates change, it takes a while for that sort of like trying to uh, throw really heavy rope, right? As you try to push that
Right.
waveform through it. It takes a while to come in. So short-term rates went down, but conversely, long-term rates recently have gone up,
Okay,
which
so from right there, even if equities are the attractive run right now, the attractive option right now, people do see rate cuts as risk on time, bullish for equities, but you still need bonds. So where do you go to navigate a Fed easing cycle that kicked off with that 50 basis point cut?
yeah. So we think that the first point of call is to ask, where were you? And we're assuming most folks
Hmm.
were sitting in cash. We hear a lot, we get a lot of those phone calls, and we deal with a lot of folks who say, I've got 20, 30, 40, 50% cash. What do I do now? And our answer is, well, you probably want to start putting some of that to work. And certainly risk assets, so whether that's large cap US stocks, you're probably going to see an interesting run in small cap stocks that have
Hmm.
been waiting for freer capital to come into the marketplace. But that doesn't mean you have to abandon it. I mean, first you got to where are you comfortable? If you were in like TBIL making 5.1% and it goes down to
TBIL, tell us what that is. Just you gave the ticker, but tell us what it is.
so TBIL is a fund that we look after. It is the on the run 90-day US Treasury. So we own
Okay.
that Treasury. When you think of the risk free rate, this is the thing that generally goes into all that risk model. So this
All
is
right.
when rates move, this is the thing that is most responsive to that. And if you looked at it, say T bill, and you say, I'm happy with five, a little over 5%, and I'm still pretty happy at say 4.6%, there's not any immediate impetus to rush to the exits, right?
So with
Rates are going to
TBIL, let me just, like I said, I want to keep it as simple as possible here. With TBIL, that the yield on that is going to be in line generally with the 10-year Treasury bond, right?
so TBIL will be in line with the Fed funds rate that you're
Okay,
going to
the
see.
short, really overnight rate then. Okay,
This the
gotcha.
super short rate, and this
All
is
right.
where we talk about that other thing in the yield curve, inversion,
Uh-huh.
which folks say, "Oh my God, inversion is a harbinger of recession and then depression when it's there for so long." But there's no law on that. There's no law in the books. There's no law of nature or physics that requires that to be true. It's weird for sure, right? In a prolonged inversion, we don't have any real data on because it hasn't
Hmm.
happened in this way. So we have to wonder, well, okay, what does it matter? And what are we trying to garner from that? Well, in general,
Hmm.
a normal yield curve has that nice sort of slope, up and to the right.
I just want to, like I said, I want to keep it, real here. the yield curve, when we talk about the yield curve, it's the yield on short-term bonds versus longer-term bonds. And in a normal curve, the short-term bonds the yield is lower than longer term. But right now, and as I understand it, for the longest time in history, shorter term bonds have been yielding higher than longer term bonds. That's the inverted yield curve, correct?
Exactly. That's exactly
Okay.
correct. And we have to ask, well, why should longer term bonds yield more than shorter term bonds? And
Mm-hmm.
the answer generally sits in the thought that something that I'm going to get my money back 30 years from now, I need to
Mm-hmm.
be paid more money to one, lock my money up for that period of time, and two, to deal with all of the things that could go wrong between today and 30 years from today. I have much less fear about what's to happen between today and 30 days from today
Mm-hmm.
or 90 days from today. So in theory, you should require as an investor less yield because you have more security that you're going to get your money back and you're going to get it back faster at full value. So that gives rise to the theory that these yield curves should go nice up and to the right. When you have an inversion, what the market is saying is, hey, hold on. We actually think it's safer to invest longer than
Mm-hmm.
shorter, which that just kind of that doesn't really compute. Like there's not
Right.
going to be a default of the U.S. government in 7.5 years, but magically in 10 years we're going to be fine. Like something
Mm-hmm.
doesn't make sense about that, and that gives economists a lot of difficulties, and it gives investors this weird spot of, well, why would I ever take more risk if I'm being compensated to take less risk? And
And
for
why would you right now? If the yield curve if it is inverted and it looks like it's going to stay inverted for a little while, why should you be moving out on the curve at all?
Yeah, so if you really like it and you only are searching for just yield, then
Uh-huh.
there isn't really a lot of impetus to move from the 90-day, like a TBIL, to say this is 6 months or a year, right? And you can buy XBIL and OBL for those. The question is though, what do you if you're not looking for just yield, if you're starting to
Mm-hmm.
look for total return, now you need some duration, right? And not to take us too far into something totally different, right? But since we're talking about yield curve and we're talking about inflation, a lot of advisors ask us, well, what about tips? And they tell us how much they disdain tips because they bought them for inflation protection and they lost money.
Yeah.
And the problem there is it's true, they lost money. The tip part worked though. The inflation protection worked. What they
And again, tips, Treasury inflation protected securities. That's what we're talking about, right?
exactly it is the exact same treasury that you see on the yield curve,
Mm-hmm.
but the government says, hey, we're going to adjust the price to make sure that net of inflation that happens, you actually get all your money back, right? Because if you
Okay.
lock your money up for 10 years and inflation, say 2% a year, well, 10 years down the road, that $100 you got back is probably only worth in real terms 70 something dollars.
Mm-hmm.
And the government says, okay, we're going to fix that. So we're going to give you that money back to make sure you're compensated for inflation, which is a great feature. The problem
Mm-hmm.
is when you do that over a long period of time, you have this thing of why it's attractive to go further out in the yield curve duration. It's that sort of inherent leverage in a bond because yields are quoted in annual rates. This is how much
Mm-hmm.
you'll get over a year. But obviously, you're going to hold the bond for 90 days versus 10 years. You're still looking at an annual number. So that price gets adjusted and that sort of sensitivity to those changes over time is this duration metric. So you can look at duration as the longer the duration, the riskier, as it were, the more
Well,
reactive to changes in rates that you're going to get. So if you
what's
want more
what's
total
the short
return,
answer of what advisors should be doing right now? They be moving out on duration?
we think you should be moving out of the super short end, right? That just
Mm-hmm.
sort of like safe harbor of 90 days. And you should be
Mm-hmm.
looking at the middle part of the curve. So something like the 2 year and the 5 year. And you could
Okay.
barbell it with 2 years and 10 years, right? We like 90 days, 2 years, and 10 years, which for us is TBIL, UTWO, U2, and UTEN, U10. And that's because those issues are just the government issues them so regularly. They're big auctions. They tend to do really well. They're well attended. And those securities tend to represent, respectively, in the 90-day. This is the short-term Fed funds rate. It's pretty easy to kind of
Okay.
look at it. Here it is. The 2 year is our kind of outlook on inflation. And that's how the Fed is really starting to, view how they're going to do their jobs over the long run. And then the 10 year that is the long-term, long-run expectation of performance of the U.S. economy. So we love
Okay.
those points because they so well map to things that we can think about in our portfolios.
All right, you referenced a lot of ETF ticker symbols there. That's helpful. But why should investors use an ETF or an actively managed bond fund versus buying and holding individual bonds to maturity? If I buy a bond, whether it's a treasury or a corporate, a high investment grade corporate, I mean, you got a pretty good almost guarantee you're going to get your full return, including the interest, if you hold it to maturity. So you buy it today, a 10-year, it's yielding 5% or something like that. You can do the math, and that's what you're going to get in 10 years or 5 years or whatever. Um, why isn't that better than buying an ETF that has so many moving parts underneath and it actually has a small fee in there too?
Of course. Well, the short answer is most folks should try and come back and talk to us afterwards. Buying bonds is just different. I mean, this is
Uh-huh.
it's not a lit market. It doesn't have an exchange where prices are well known. Who you know matters a great deal for the price you can get. There's not a centralized clearinghouse where you get a guaranteed trade like you do when you buy an ETF, through a retail platform. There are delivery fails that happen all the time. Not to mention, in a nod to bond math here, these things are still quoted in fractions. And it's confusing when you see the dollar price and it doesn't quite map to what you would think the inverse of the yield should be. There's a lot of bond math that has to happen just to understand the quote line of a bond. And on top of it, it doesn't have a convenient ticker. So you have to enter a QSIP, it's 8 digits.
Uh-huh.
You get off, you put in a B where you should have put in a D. And before you know it, what you bought was completely different. And the bond along the way is going to give you likely an interest payment, right? If it's a US Treasury that pays a coupon, it's going to be every 6 months. Some bonds are every 6 months, some are annual. They're not all the same in the IT market space. Some bonds have all sorts of other features where they can be called away from you, or there's an opportunity to tender it early and you have to pay
Uh-huh.
attention and know how to do that. It's just, for whatever reason, the bond market hasn't evolved much in how it behaves other than going electronic and getting faster in the last 200-300 years. And that's fine if you're truly dedicated and you're professional, and we have teams of folks who do this with professional systems. We're fully equipped to do it.
Okay,
It's the kind of
all right, beyond the logistics of it, which you have made sound very unfun, uh, what's there still is that buying it and holding it and knowing what you're getting versus a bond fund that is doing, I mean, I can't possibly get the same guaranteed yield in a bond fund as I can get from buying a bond and holding it to maturity, correct?
that's totally correct. And there are times when, obviously, if you like that yield and you've got
Hmm.
a, like, say, a specific liability and you want to know you can rely on that cash flow and getting your money back at the end, you should absolutely do it. And
Okay.
that's where some of the bond ladders come into play. Folks
Yeah,
say, okay, well,
you just moved
yeah,
us into our next topic, bond
uh,
ladders. All right. I want to ask you about bond ladders. It seems to have created a little bit of a division amongst investors and financial advisors. I find financial advisors that say bond ladders are the easy thing to do. You ladder them up, and by ladders we mean you incrementally invest, whether it's individual bonds or there are ETFs designed for this that mature on regular intervals, and when a ladder matures, you take that cash and you either spend it, depending on where you are in your life. Maybe you're retiring, maybe you're still saving for retirement, or you could spend it depending on where the markets are. You could buy another bond ladder at the other end, or you could maybe put that into the equity market. So that's what we're talking about with bond ladders. But I find, and you and I talked about this earlier, Alex, about bond ladders are more like kind of like comfort food. They don't really make that much difference versus buying bonds and just investing longer term on these. According to you, I hope I'm paraphrasing fairly, but I don't know. I personally I kind of am a fan of bond ladders. I like what they do and I like how they do it and I like how they kind of simplify bond investing. But what's your take on it? Let's hear you kind of break them down a little bit for us.
sure. So we run a lot of bond ladders for clients, and we too are big fans of what they are
Hmm.
in the right channel and folks who appreciate what they're getting. And it's a good way to diversify that one bond that you might otherwise buy, right? Okay, as opposed
Okay.
to saying, here's the exact yield in 5 years, maybe I'm going to spread that over 3 to 7 years, where I'm going to get a little more diversity of the actual holdings I'm going to have, right? I'm going to get a little different coupon. And on average, I'm happy with that experience because I've now kind of dollar cost averaged into the yield curve. And I know the exposure set I have. And as time goes on, I can reinvest or I can always choose not to. So we think there's a lot of value in that for folks who understand and want that sort of experience. And deep down, a lot of active product is essentially a bond ladder of some sort, right? We don't
Uh-huh.
put 100% of our active bets in just one part of the curve or one name or one coupon, right? So we're all trying to keep in that general philosophy. The way that you look at the ladder though is where we think there's a divide and makes a lot of sense to ask. Some folks really want to see those bonds in their accounts and they've got great reason for it and they want that surety and we're happy to deliver that. Other folks
Okay.
who are using the ladder to hit a certain part of the yield curve or get a certain exposure have through our funds now a new tool. What if you got a ladder, but as opposed to the top rung, like an escalator constantly coming to the bottom and refilling it, what if it just stayed right in place? And that's
Hmm.
what other ways of approaching this are. Say, I'm using the ladder because I want a certain characteristic. I want a certain duration. I want a certain exposure, and I want that to naturally float with the market benchmarks to make sure that I'm not having this like unnatural exposure to the market. And so, we give folks two different ways to play. There's the we buy the bonds for you and they go to, as they mature, we reinvest, or through the ETF product where we just keep rolling to the on the run for you. And, folks ask us, well, why would I want to stay in that same bond versus this ladder, where I'm going to get all the rungs at the same time? And our answer is if you wanted to exit that bond ladder early, or if you want to exit
Hmm.
any bond that isn't freshly issued, just given how the bond market trades, you tend to take a discount to do that. So for folks who want to be very nimble, where they're trying to be able to reposition themselves, or they're not certain how long they're willing to make this investment for, we think it makes great sense to stay on the run in the bond market. We do that
Okay.
by staying on the run of treasuries. We do the same thing in the IG space by buying more recent issues. And we find that folks get two things they really like. The yield and the coupon rate they're going to get tend to be much closer. So they're not going to wait 3 or 5 years to get that total return, right? Because to your point, you can lock in a yield of X, but you're only ever going to get the coupon along the way. You're going to get
Hmm.
all the rest of it on the last day you own the bond. And some folks have the patience to do that, some don't. And we want to give folks options for that. And also, when you stay on the run, you get more, that liquidity is better. So you're going to notice that the price over time fluctuates less. In the end, it's the same bond, has the same security, but we notice that some folks like to see that greater stability of price because the spread is so much narrower.
Okay. Let me, we got a little time left here. I want to hit you with some lightning round. All right.
All right.
Uh, TLT, the iShares 20 plus year Treasury bond ETF. It is wildly popular. Money moves into it, money moves out of it. I, I am not the biggest fan of it. I don't know why people are chasing this thing. What is your take on that strategy and that ETF?
And TLT appeals to the duration lover in us all. This is how do
Okay.
you get as far out on the curve, get that most impact for price as possible. So if
Hmm.
you think rates are going to move, right, like short-term rates are going to move from 5.5% down to say 3. Well, 2.5% is not a tremendous amount of actual total return, right?
Uh-huh.
And if you looked at that on the 90 days, divide that number by 4. So the way to get more action, as it were, is to take more duration. And TLT, which has been around for a long time, is has become the de facto answer for getting lots of duration, quick and cheap, and it
Okay.
it delivers that. Which also means if rates don't go exactly the way you expect, they're going to go that opposite way much harder and faster because it has so much duration.
Okay, we talked about the yield curve a little bit. What's the outlook for it? Is the Fed's current policy, which looks like easing, is that going to correct the yield curve?
Yeah, we think it's going to correct it some. It's going to bring down the front end nice
Uh,
and slowly. That's their goal, and we hope they stick the landing on that. And we think the curve in the shorter end will start to get lower, right? Because the curve don't forget, two things can happen. The shape of the curve can change, and the overall positioning of the curve relative to the zero marker can
mhm.
change. And so we think the short end will come down. In the short term, though, we think the long end of the curve is actually going to go up because it's the investors are just going to say it's less attractive to own those bonds, and their money is going to go more towards the middle and the short end of the curve. If we then forecast out, 2 years down the road, we expect to see a more normal environment, and we expect that curve to start to naturally come down a bit. But there's a lot of things that can happen in the next 2 years. We're going to have an election in a few months. We're
Yeah.
going to have new policymakers that come in at the Fed, including a new chairman. And there's a lot of things that could happen to change how we get from here to there.
Okay. Final question, cash. You mentioned cash earlier. There's something like $6 trillion sitting in cash or cash equivalents right now. The interest rate move is believed to drive some of that cash. I say sidelines. It's hard to call it on the sidelines when it's making 5% in some of these accounts. But if those short-term, ultra short-term accounts start to yield less, it sounds like you're saying, I mean, it's not all going to go into stocks, which is risk on, and it can all go into bonds, even though because if it does go into bonds, it's going to be going in longer term, longer duration. Where do you see cash moving kind of largely?
Yeah, I think we're going to see a good chunk of that go to the stock market, and particularly large cap ETFs because it's easy, right? If you look at the
Right.
average day in the US, consolidated tape, about 1 in 5 trades is an ETF. If you look at days when there's big market movements, it's almost 1 in 2 trades is into an ETF, and it's not
Uh-huh.
going after like a gadget drone ETF. That's going after the large beta names and equities and bonds alike. So we think it'll go there because it's kind of the de facto place to go. And if enough money goes there, chasing that scarce number of shares, prices are going to go up, which will encourage more money to come in, and that's how you make a melt up. And
Okay.
there are probably elements of that, but we do. I think from an advisory standpoint, having a target asset allocation, this is a great time to make sure if you're not where you want to be, that you get there. Because long term, those melt ups, and those sudden movements are going to happen. But investors are best served by knowing they are able to meet their long term financial objectives, which is a certain amount of return, a certain amount of cash flow, and a certain amount of dampening of volatility. So no matter, even if we see a lot of it go short term into large cap or even
Hmm.
small cap equities, this is a good opportunity to remember we're not doing this for the next 3 months. We're doing this for the next 3 decades.
Yeah.
And how do we position ourselves to help clients meet those outcomes?
All right. On that note, we're going to leave it. Alex Morris, Chief Executive Officer at FM Investments. And that was your latest installment of Bond Math. I'm Jeff Benjamin, Wealth Management Editor at ETF.com. Check out ETF.com, especially the Advisor Center. We've got a lot going on there, folks, and it's all designed for financial advisors, professional investors. If you want to reach out to me directly, I'm at jeff.benjamin@etf.com. You can find me on X. My handle is @BenjiWriter. Thanks a lot, folks. Thanks, Alex. Talk to you next time.